What's up, everybody? We figured we would do a Facebook Live because there's a lot of stuff happening in the world of banks right now. SVP Signature was another one that Jeff, you texted me that recently as well. And Jeff's always had a ton of insight. He pays very close attention to the real estate markets, the crypto markets, the lending markets, kind of you name it. You have a really good pulse, and have been able to formulate a lot of data-driven decisions around where you feel things will kind of go. So. Super excited to have you on here, Jeff, and tell us a little bit, like, what's your background, man? Bring everybody up to speed who doesn't know Jeff Van Note.
Yeah, I think most people get into a business not knowing where it's going to take them, or get into a career. I can tell you that I've been like a lifelong residential, commercial, private real estate lender, investor. Right now, I am more focused on the commercial private money aspect of it, just due to what's coming in the market. It's a much more professional, sophisticated level. And I always believe that, if you solve problems, you make money, right? At the end of the day, whether you're a realtor, an accountant, an attorney, most of our money is made by solving problems or helping people through service to get to where they want to be. One thing that I've tracked really probably since 2016, 2017, is the ongoing growing of the residential and real estate space in general, specifically the commercial mortgage markets. So I have been tracking data, dealing with banks and understanding not only their lending guidelines, but their psychology and mentality on how they lend.
Yeah, no, that's incredible. And I feel, you're going a lot deeper in what it is you're doing. And I feel like that's a perfect segue into the SVP or SVB component, where I was at. I'm sure you know Barry Habib. I'm sure you. Yeah. So I was at an event on Friday where Barry Habib gave one of the most badass data-driven spiels about where the real estate market's headed and how a recession's actually good for interest rates and how that could help with buying power, and talked about pent-up demand and whatnot. And then we get out of the event, and my buddy Mark Stein from Links, he's like, did you look at the news? And I'm like, no, what? And he starts telling me about SVB. And then, you've obviously texted me since then. And then we're looking at it, and Monday hits, and the rates they came down about 0.25%.
Yeah. So I don't know where you want to get started, but yeah, to answer your question, rates yesterday, actually from when the news broke to yesterday at the low, rates were down about 45 basis points, or 0.45%. This morning, they've since rebounded about half. So now the 10-year Treasury sits at about 3.619% in real time. Like anything, a lot of the problems in today's world stem from social media and contagion, right? The spread of fear is real. Look, if Facebook and social media didn't exist in 2020, you and I would probably still be sitting here like, yeah, what was that COVID thing? I'm actually off Facebook now. I'm doing a nice little cleanse. I don't know when I'm going to be back on. And it's more of just, it's tough to make calculated decisions when you have 7,000 people giving their opinions and screaming in your face every day. And regardless of what you use, social media, family, out of state, posting people, pictures of your children. There is a lot of noise out there, right? So I believe yesterday, while the problems are serious, right? We had a bank failure. We had multiple banks shut down and are now being under scrutiny. I do believe the initial knee-jerk reaction was oversold short-term, not downplaying the series of events, but the capitulated selling and fear was real. So I think we're in a healthy stage right now of where the bond market is as of today. And I do think we actually go higher from here.
Nice. And just for anybody who's watching that hasn't really paid as close attention to what did happen, if you don't mind, I'm sure you're able to explain, considering you're in that lending world, what created the issue.
So my belief, now, to keep it simple, most banks get your deposits, right? And then lend, and they make what's in the middle, right? So they lend here and they borrow here. So they make the spread, right? What we saw over the past 14, 15 months now has just been a rapid rising interest rate market with a lot of volatility. And I actually brought up, am I able to share my screen, Brett, or no?
I think you can. You hit the present button at the bottom in the middle.
So the reason why I wanted to pull this up is I wanted to show everybody what this looks like from a monetary standpoint. And Brett, can you see this chart right here?
There we go. Yep.
You can see this chart? Okay. So this is just an example, and this is no set parameter. I just want to show you kind of how this looks. And I think, again, this is part of the problem. I'm not saying this is the overall problem, but when banks lend money in the mortgage market, the bonds have spreads to them, right? So as of yesterday, for example, and again, this is like a different scenario, but you'll get the gist of it. If you had a mortgage at 4.6, or if you wanted a mortgage rate of 4.625% on a certain loan product with a credit score, you would have to pay 13 points or $102,000 to get even on that spread, right? Because rates are almost 7%. So these are buying down the rates, right? Now, again, as you move up, let's look at, for example, 6%. Well, if you wanted a 6% rate on this particular loan product and credit profile, you'd have to pay 5.7 points. So you take 100 minus this number, and that's the spread that you have to pay just to break even. Okay. And then again, if you go up a little bit to 7%, you pay 4 points, right? So you can see the difference between 7% and 4.625% from a spread. It's $31,000 versus $102,000. So I'm going to stop sharing for a second. And the whole point of me showing you that is for every, let's say, $1 million, right, there's plus or minus 8 points in there, right? So a lot of banks lent money thinking that rates were going to stay stable, but because they literally went from 5% to 7% overnight last year, banks got stuck holding non-valuable assets or not as valuable assets, right? So now a bank's in a predicament where do they sell that off and take a loss, right? And banks aren't in business really to take losses, or do they just hold the loans, right? So banks got caught lending loans that they can't essentially sell at a profit, which ties up their capital for longer periods of time. In addition to that, and you know this, banks were lending large-scale construction loans, multi-million-dollar investment properties, multifamilies, in certain 3, 5, and 7-year terms that they thought were going to be able to be refinanced at a favorable, somewhat similar rate, and let's say 4%. Now rates are at 7%. Those people aren't refinancing. They can't cash out. So all these banks have been doing all these loans, and their loan pile has just been growing and growing and growing and growing with the inability to turn over the loans, right? So that causes a cash crunch. However, and that's just, again, when I say part of it, that's more about what's going to come and where the real exposure is. And that's where Signature really has exposure, which is probably why the Feds are looking at them. They have more exposure in the commercial real estate market, to my knowledge. They were also a crypto lending institution, right? So I believe what we're seeing now is a fallout from the FTX collapse, right? And I don't think most people, or no one's even really talking about that to the masses yet, but a lot of people were hit with margin calls. And the company Celsius, for example, went out. There's another company called Maple, MPL, which was a crypto lender. When anything drops 75% overnight, people get caught with their pants down, and what they owe is much greater than what the value is. And the bank needs to cover that loss. Yeah, technically the consumer does, the person that borrowed the money, but what are you going to do? Go to their house and make them sell their valuables? You're not, right? So there's a liquidity squeeze. From the lending world, banks have to keep their lending to deposit ratio under 110. That's like that magic number. I can tell you that as of June last year, and this is, again, kind of scary, that was 9 months ago already, most banks were over that 110 mark with the sentiment of, oh, things are going to get better. Rates can't go much higher. We're going to get paid off, right, on loans that they've done. And deposits are going to keep coming in. Well, if you know anything about inflation, which is all over the headlines, inflation causes people to dip into their bank accounts, right? To pull from their savings. if we're in a higher interest rate market, it prevents people from refinancing and cashing out. So where are those excess deposits going to come from? And that's why you see banks chasing deposits right now, giving 5% APY, right? Come over and we'll give you a $500 bonus, because they don't have, and this is every bank, maybe with the exception of JP Morgan Chase and Goldman Sachs. This is my opinion, and I haven't analyzed the numbers, so I don't have the time to do it. If every single person who had money at a bank, any bank, every single person at that bank went into that bank branch or that bank institution and said, hey, I need all my cash out, the banks don't have the money, right? Yeah. And that's the bigger problem of like the systemic risk right now is, and that's why First Republic Bank, I'm not sure if you saw yesterday, they halted trading because the bank stock was off 70%. Because when you create fear and panic, like let's say we both had $1 million at Signature Bank yesterday.
Yeah.
We're probably, hey, do you want me to pick you up so we can go pull out our $1 million each? Like, for no other reason than why do you want to deal with the headache and the nonsense, right? Not that the money's fully at risk. It's just real fear. So when they talk about like the gold standard and everything from lending, there was supposed to be, for every dollar of cash, a dollar of gold backing that cash. Well, we've gotten away from the gold standard, and now the paper doesn't even exist. There's not even an actual dollar bill that backs all of the digital balances that you see in your bank account right now, right? All it is digital saying, hey, Brad, I just Venmoed you $100. You get an alert, hey, I got $100 in Venmo. Oh, I just transferred $100 to my bank account. There's no real money being transferred. It's a promise. It's a big IOU. So when you unravel the whole entire debacle with Silicon Valley Bank, they were a tech startup or a new venture company, right? That's who their clientele was. So they would get deposits from VCs and they would lend against those deposits, right? So like Facebook just announced literally right now that they're cutting 10,000 jobs and they're pulling 5,000 job listings. Now, is that a direct correlation to SVB? Maybe. Or is that a bigger problem that's been coming? But unravel that, Brett, down to, okay, 10,000 people just lost their job, right? 5,000 people now can't apply for these new jobs. Well, if you don't have a job, you can't pay your mortgage, you can't pay your bills. So with SVB, when they said that they were going to only insure up to the first $250,000, the Fed backstopped them. So if you had $10 million with them, the Feds are saying, we're going to make you whole at $10 million, because that money that was sitting in those accounts, the majority of those funds were used to run the business, pay your rent, operational payroll, health insurance, right? So now you freeze $2 billion of working capital for startup companies. The only inevitable option is companies close and people get laid off, right? Because all these tech companies, including Amazon, run at losses. So that's why the Fed stopped in to prevent the additional fear and the contagion and the widespread catastrophe of what could have happened. Forget about the companies going out of business, forget about the banks going out of business. It was the trickle down to the job losses and then the future defaults.
Yeah. Yeah. And from what I understand, I mean, there's some, I've heard, I don't know if any of this is true because it's probably coming to me through social media and all stories, around that, but I've heard Ojo, which is a big real estate lead source kind of startup company, well on they're past the startup phase, but they're backed by them. And I've heard they're missing payroll. Again, I don't know if this is true or not. And I heard realtor.com too is also in our industry and backed by them as well.
So I have a client I'm on the phone with last night, multi-million-dollar client in Manhattan, millions in the bank, works for, people forget, most of the stuff we like, StreamYard, tech startup, Netflix, tech startup, Amazon, still in the startup phase, even though it's been around 25 years, right? The majority of services that we use today, Facebook, Instagram, whatever, these are all startup entities, right? Which means that they have exposure to SVB. So my client works for a company. I can't say it because she said, don't say this. You didn't hear this from me. She had her Expensify is a startup. They had to freeze their Expensify cards and they had to use their personal credit cards for business expenses for the foreseeable future. So and when I said that's somebody that I just happened to be on the phone with last night that I'm working on a multi-million-dollar bridge loan for to help them buy a multi-million-dollar property in Tribeca. And they asked me, the first thing they did was, hey, Jeff, are we okay? Because I'm using one of my local lenders, right, to do the bridge loan. Hey, are we okay? I'm like, yeah, guys, everything's fine. Like, there's no exposure here. It's not a tech-based, bank, da-da-da-da. And then 6 hours later, she's like, wow. She was like, I just got the email from X, Y, and Z saying I can't use my Expensify account anymore. So everyone or that we know in this space, somebody's going to most likely be directly impacted just by the nature of our demographic where we're located. And I think if you're going to drop a bomb right now, you got to look at the Silicon Valley area, demographics, suburbs, right? Inner workings. Like, most people bank locally. So if you're in that tech world, you're a tech CEO or a tech exec, where'd you have your money? You had your money where all your buddies had your money. So again, who knows what shakes out of it? What I will tell you is I think that from a lending standpoint, this does drive up the cost of private capital, because if there's fear of banks going out of business, people are going to want a premium on their capital. You can't continue to give money out if banks are not stable.
Yeah. And that too is something that we were talking about where this really is inflation Fed's driven. It's that rate hike. It's right around when that happened. It's SVB's chief risk officer stepped down or stepped away in April. And my understanding is she was paid through October on the books, but she actually stepped away from the company in April. So there was also 8 months of them not hedging what they're supposed to be hedging and kind of playing the safe way of going about this. And then it just hit.
Yeah, and I think you bring up really great points. And I think for myself, what I've been through both personally and business, I've learned that hope is not a strategy, right? Hey, we hope the market gets better. Hey, listen, we can say whatever we want, right? When I underwrite clients' commercial mortgages and private loans today, I always build a 2% buffer in. Hey, listen, the rates are at 5.9% right now on this certain product, right? Who's to say rates aren't 2% higher 5 years from now? I'm still going to underwrite, even though we're going to get you 5.9%, I'm going to underwrite you to 7.9%. Why, Jeff? Oh, I think rates are going to 3.9%. I go, look, you and me both, right? But every single person that borrowed money at 3.5%, 4%, 4.5% on 10, 15, $20 million deals for 3 and 5 years are now in a position where they're underwater, right? So I think that a lot of people are checked out, especially in the executive bank space, because they're paid a fat salary. As we saw publicly, all the top execs sold out the day before, shit hit the fan. And I just think people are so checked out. And that's why, and you and I have had this conversation, I talk about skin in the game. Look, if you're lending someone else's money and you don't have any attachment to them and you want to screw the bank over, so blessed, be it. Right? But when you're losing your own money or you're lending somebody your own money, you want someone to have skin in the game because they're less likely to walk away. And I think what we see in the banking world is a prime example of it. These people pulled their money out the day before. They had no skin in the game, and they left the people that had money at the bank kind of holding the bag. So I think we're going to see, I don't know if it happens overnight, but I do think we're going to see, we've already seen tightening in the lending world. I think we're going to see additional tightening in the bank lending space, which, as I said earlier in the call, the private capital markets, are just going to absolutely thrive from it. But you're going to pay a premium for someone's private capital at this point.
Yeah, no, I certainly agree. And I feel like that too is one of those, there might be more. We're in that market right now. We're in that economy where, Warren Buffett said, the tide's going out, and you're going to see who's swimming naked, and that's a very true statement to this. This might just be the beginning of it. Fortunately, it seems like the government's going to do what's not called a bailout, but they happen to have $100 billion set aside that they're going to give $27 billion to the people who had deposits, perhaps, which is them not bailing out the bank, it's bailing out the people. So we'll see what happens there. But yeah, I think there's going to be a lot more, checks and balances and stuff. But I think that the core of what you're saying is that it's a fear-driven mentality that social media is driving. Obviously, the Feds didn't help. There's errors that happened while, in the last, 11 months of what SVB could have been doing to kind of hedge against this. But where do you see, Obviously, you're heavily tied in the private equity world or private money world with lending. Where do you see it going, for residential real estate? How do you see this affecting
Still
anything?
higher. I don't think it impacts residential real estate at all. And again, I think, put it like this: at some point, people have to make money, right?
Right.
And you and I have had this conversation since the day we met back in 2014. Of more, there are mortgage banks that use Loan Depot as an example, right? Publicly traded company, best rates in town. They lost 97% of their revenue last year, right? Because they're not doing profitable business. Like, it costs money to do business, whether you're a realtor running your own team, whether you're a gas station attendee, whether you're a restaurant owner. Like, costs are costs, and whatever's left over after the cost is your profit, right? So we've seen a lot of people run businesses like hobbies, or run businesses based out of ego, just how much business they've done, but they're not making money. What I want to show you, so residential real estate is still going to be fine. I don't care, right? Especially in the metro areas that are surrounding larger scale cities, like New York City, for example, and not to be funny, the client that I was speaking to that I was referencing earlier on the call with the Expensify account, between her condo maintenance fee and her taxes monthly on a $5.2 million place in Tribeca, which is sick, by the way, $12,000 a month just in condo fees and taxes, 12 grand a month, right? So, you know what? Maybe one day she's like, you know what? I don't want to do this anymore. The kids are getting bigger. Honey, let's move to Bergen County. Well, between taxes and a mortgage, you could probably get a $2 million. I'm giving an example, right? A $2 million home, put 20% down, and have taxes and a mortgage for under $12,000 a month. You might be at $11,000 a month, right? So when you have that massive wealth understanding in Manhattan, a lot of people are paying $4,000 to $7,000 a month in rent. So if you look at these cities with very high rents, within an hour, and now with the ability to only work in the office 2 days a week or whatever that is, it has to spill over. Now, there's going to be household pain. In the first book I wrote, I said that 2008 won't happen again, larger scale. It will happen for individual people. So people that are on fixed incomes, people that don't have side jobs or side hustles, there will be pain. But we are not going to see a drop in the residential real estate market, regardless of what interest rates do, because all people are going to do or have to shift down their affordability level. So if you're looking at the $1 million price range, maybe now you have to look at the 750 price range. If you're at 750, maybe you gotta go to 500, or maybe you have to go out to Pennsylvania or go southern into Jersey. But then all areas right now are so properly secure, right? From an understanding of like an economic standpoint, we're not going to see that drop. I think entrepreneurs are going to see the biggest hit right now, small business owners, because people aren't spending that extra money, to go and eat at a restaurant 5 days a week, right? They're going to go and buy groceries, but then the grocery stores make more money. So it's going to be a healthy balance. But what I did want to show you, Brett, and this is where I think people are going to find the most value. I'm going to share my screen again. This is where the real exposure is in the market right now. And forget about what just happened with SVB. This is every single bank has this exposure with unforeseen risk. So can you see the screen?
Yep.
So let's just say, for example, somebody last year, and again, I put the numbers in so you can see I put in monthly rents, both commercial and residential. So I didn't manipulate anything. But dollar for dollar, let's just say somebody took out a $1.36 million loan on a commercial property for 5 years at a 4% rate. The DSCR, and this is where banks are really playing hardball right now, they're raising all their requirements from a cash flow standpoint because they're expecting people to default, not pay rent, businesses close, right? So if somebody got a $1.36 million loan and you need to hit a 1.25% DSCR, and now rates, again, let's just be conservative, are 5.9%, you're at a 1.04, which means that you have to get this number back up. So the only way to get that number back up is to drop the loan amount. So not to really be the bearer of bad news, but as you can see here, as we play with these numbers, somebody in this case today would have to bring a little bit over $200,000 to the table just to refinance their loan, right? And that's a problem because rates really aren't at 5.9. They're closer to like 6.5 to 7. And then if you want to magnify that, to 10 million or 20 million, the interest rates are really going to prevent people from refinancing. And people are going to get stuck in these bigger loans. And like we spoke about briefly earlier, where the construction loan exposure to the market, banks, hey, here's $50 million. Go build this beautiful rental building in Hoboken, right? Let's underwrite to a 4% rate or 4.5% rate when you go to refinance based on cash flow. Hey, we could support 50 million. Well, now that rates are, and let's just use 30% as an example. So that 50 million at 4% is now 35 million, right? At 6%. So you're going to have developers probably either going to have to force to sell or debt restructures or workouts, which causes losses and catastrophe, messed up credit all across the boards. They mostly personally guarantee those larger construction loans. So if there's an opportunity in the market, I would tell everybody that's listening to this call, I like the mixed use space right now. The 2 families over commercial, the 4-unit residential over 2 commercial spaces, because bank guidelines have tightened so much. It's essentially impossible to get a mixed use loan in the market right now unless you have experience and a banking relationship. That's where I see opportunity, because if you get into a property now, it's undervalued, underfinanced, and rates are at 7%. If rates drop to 5%, you could see a 20 to 40% upside literally overnight in valuation, 18 to 24 months. So if you're looking for opportunities, look at underperforming mixed use assets, because that's where banks have stopped lending, and real estate only goes as far as capital goes. So if you look at the areas that banks are pulling back from lending, if they're less financeable, there are less people in the market that are able to acquire those pieces of real estate, which means cash is king or private money is king in order to get you into that type of real estate.
100%. 100%. I totally agree. And Jeff, I got to wrap, but I appreciate you coming on. If somebody wanted to get in touch with you, whether it was on the residential commercial lending side of things, or if they want to buy one of you have 2 books, right?
Yeah. Yep.
Cool. How would they get in touch with you?
Yeah. I'll give my cell phone number, reach out to Brett. He'll send you my cell phone number. That way I know that it came through Brett. I think, look, at the end of the day, Instagram is fine. Social media is okay. I'm a big in-person person, right? If you have like serious stuff you want to talk about, let's get together. I'll treat you to lunch, dinner. Right now, we got to get back to FaceTime and forming interpersonal relationships, because we are going to be going through a war, and we're all in it together. And I think a lot of people forget that regardless of your profession or industry, like, honor thy neighbor, right? Like, we need to start protecting our neighbors, because we're all in this market and chaos together. And the other thing is there can't be any experts right now, because we've never been at this stage of the economy ever in the history of America. So go with the people that kind of have a touch on the pulse, and also that are forward looking. And if something does go wrong, like we said earlier in the call, how do we solve those problems? And the only way of doing it is by sticking together and surrounding yourself with like-minded people. So absolutely. Again, cell phone, email, all that stuff is fine to reach out. Just stay optimistic. If you're anxious on what's going on with your money in the bank or the markets, take a deep breath. Sometimes the best move is to do nothing, but also be careful of who you take information from. Yeah.
1,000%. And then also too, you've saved my ass a few times in the past too. So I can tell you guys, Jeff's a good person to have in your pocket when things get rocky, because he's nimble and super creative. So
going back to that, I think because that's what friends are for, and that's what a relationship is. That's my opinion, right? So like, if you need my shirt and I only have one shirt, but I know you need it, I'm going to give you my shirt. And I think that's the difference of transactional lending and borrowing versus like a true relationship behind the actual transaction.
You should buy more shirts, because I think a lot of people are going to need shirts coming up. Reverify.com. I'll see you guys later. I appreciate it.